Hey, good morning. It's Aquiles from the car. 25 degrees here in New York City and a balmy morning. At least we don't have wind, so I can't complain about that. Talking about wind, the market trade winds are looking right now a little bit laggard in terms of pushing different stocks, different sectors. It seems that the earnings from Broadcom, they weren't great. They weren't anything out of the ordinary, but it does make for an interesting commentary. And what does that really mean? That just means, am I going to pull back from the future spending? Now, every company that goes into artificial intelligence spending knows that we're not going to see dividends from that spending right away. They're playing the long game when it comes to that. So as an investor, if you own these stocks, like Broadcom and other AI concerns, you want to ask yourself, I'm not in this for the trade. If you're a trader, then it's a different story. But if you're in this, I'm in it to win it. I'm in it for the long game. And I think that that's important to remember. Also, we're talking about something else. I was thinking about this yesterday, and it just so happened to be in the Wall Street Journal today that they mentioned bonds. Bonds are a little bit boring, but if you think about it, the bond market is much bigger than the stock market in terms of size and breadth. Now, they cut interest rates, but Powell kind of gave a mixed message where they're taking a more hawkish stance. So may not see more cuts just yet, but they're going to start buying up treasuries. And that means if you are looking to get into treasury bonds and the like, you may want to get in now, so that way you can make some money on the appreciation. Oh yeah, bonds go up in price. So, typical bond is $1,000. And if it goes up, people don't just own one bond. They own a lot of them, so they're looking for a decent return. Plus they get the state tax benefit from that. Keep that in mind. So that's really just that part. Bonds need to be a part of your portfolio. Maybe not individual. Maybe you need to do a mutual fund. Maybe you need to do an ETF. Maybe you need to own some other concern. But keep it in mind. Next thing I would bring to your attention is that we're heading towards the end of the year. If you're looking to really maximize and make a little bit of an impact on your taxes, now is the time. If you're self-employed, make those contributions to the 401k. If you're an employee, same thing. If you have a tax-deferred 401k, make those contributions now. If you haven't maximized it, now is the time. There are plenty of opportunities to make money in this market. I always tell people, we've said this before, the more money you have on the sidelines, the less your portfolio performance is going to be. But if you strategically get into the market, going in bits at a time, maybe not necessarily dollar cost averaging, with the same securities, but going in, being strategic, being smart and intelligent about these things, you could come out ahead. There's a lot of opportunity out there. Always keep a little gunpowder dry. I say, you never know when you're going to need it. So that's another thing. Who are the best kind of clients who work with us? People who are looking to retire soon. So if you're in a frame, 3 months or less looking to retire, you got a lot of micro and macro decisions you got to make. And to make them alone, really not the best strategy. I think that reaching out to an advisor who's well trained like we are, to come and give you ideas that you haven't thought of out of the box. If you are retired already, do we need to start talking about Roth conversions? Do we need to start talking about minimizing the tax bite that you're currently taking? Should you retire at 62, and collect Social Security at that point, or should you wait till 65? Should I take a lump sum, from my employer? Or should I do the annuity where, not the actual product annuity, but where they're paying you out every single month? And we found in a lot of cases, both scenarios could work for clients, but one really makes a difference. Who else? Someone who's in transition. If you're changing jobs, now's the time. You have a very limited window. Do you really want to leave that job? Let's say they tossed you out on your butt. Do you really want to leave money with their 401k provider? Who knows what type of relationship they have with that provider. I would get that money out of there and into an IRA as quick as you can. Finally, if you're sick and tired of doing this alone, why are you thinking you're going to be a financial advisor? You have accounts all over the street. They're all over the place. Why do you think you're going to do better than a professional? Schwab did a study many years ago, and it backfired on them. They thought that you didn't need an advisor, and it backfired them. You actually did between 5 to 10% better with an advisor than you did going alone. Some food for thought. Have a wonderful day, guys. Enjoy the weekend. And if you have any questions, feel free to DM me. I think we do the, DM me. Here's the button. Just kidding. Have a wonderful weekend, guys. And I hope you live your best life during those weekends and continue it on for the rest of your life. Talk to you soon.